Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
All right, welcome to Market Call. It is Wednesday. It is what? It's May 15, 1-5
Okay.
here. Guy Adami's not with us. I have EY from SoFi. That would be Liz Young. We're going to try to get all your money right in one show. How about that today? We're going to do that.
No
here.
pressure.
We got a lot to go over here. I don't know if this is like your Super Bowl. Maybe it's kind of like your NFC Championship when you get CPI day, especially over the last 6 months. They've been big market movers. We're going to break down what you saw in that print and what you think is going to happen. We're also going to talk about some things that you want to kind of play with this sort of data. If this is going to become a trend, you see that's the rundown up there. So we're going to go through what is the inflation cooling playbook. Is that a thing? I don't know.
Sure.
Maybe.
Might be.
We're going to preview some earnings. We got Cisco, we got Walmart, and we got Deere. We might hear some interesting things out of those three companies that all probably kind of weigh in on different parts of the economy, different geographies, and the like. And then we're going to talk about these big banks and what just happened here over the last month or so, especially as rates have come in. Liz, you probably have some thoughts on that. Okay, Guy's not here.
So we're not going to talk about the Rangers.
We're not going to talk about the Rangers.
Okay.
I mean, the Rangers obviously have a big one tomorrow night. They can kind of finish. Finish out this second round on the road, or they have to come back to Game 7 on Saturday night and finish it out.
How many rounds are there?
At home? Then there'll be the conference finals, which would be the next round, and then there will be the Stanley Cup finals, which would come after that. Okay. So Guy is a little apoplectic because the Rangers did have a 3-0 lead. Now they're only up 3-2, and it could get evened up down there in Carolina, but we'll see.
So
Last night,
we're going to talk about the Rangers after all.
We did really briefly. Last night, Madison Square Garden was rocking. Okay, so the Knicks, as you know, they're also in the second round of the playoffs, and they destroyed the Pacers. I was at the game. They beat them by 30 points. It was a lot of fun.
Okay.
All right, let's get into this. CPI this morning, expectations. Tim Seymour and I and the whole crew, Guy was there too, last night on CNBC's Fast Money. We were talking about how participants were set up into this print, right? We had yields coming in. We had the dollar coming in, right? We had oil coming in. We had the VIX very near lows in and around 13 or so. The MOVE index, which tracks treasury, volatility, was also near 52-week lows. So it seemed like a lot of folks were positioned for a softer than expected number. We kind of got it. What did you see, Liz? And what do you think the market's reaction, all the different markets?
Yeah. So, I mean, the interesting part is the market reaction's been positive, even on a hotter than expected PPI earlier in the week. And now we get a cooler than expected CPI. And it's like, all things are good. It doesn't matter if it's hot or cold. If it's good,
Goldilocks?
good.
Is that what you're saying?
No, I didn't say that. Okay. But the cooler than expected CPI was the month over month number came in cooler than expected, which is definitely positive. The year over year numbers came in pretty much bang on expectations. I think the market was bracing for, if there was going to be another upside surprise, we would have seen some volatility, but something that was on expectations or below was going to be positive. And then you saw the likelihood of cuts come up a tiny bit. Now we're looking at 2 cuts by the end of the year, likely starting in September. At least that's what the futures markets are expecting. So here's what's interesting about CPI in this particular month's print is that when you look at the trend, and I'm going to kind of jump into a chart that I used actually for the column. When you look at the trend of all the components except for shelter and auto insurance, you look at the contribution of all those components. So basically what that means is you get a headline number of, let's call it 3.4%. How much does each component contribute to that headline number? When you look at all the components except for auto insurance and shelter, everything is about back to its pre-pandemic contribution. Okay, not its pre-pandemic price level, but its pre-pandemic contribution. So perhaps we're normalizing a little bit. Okay, so there you see the big rise that happened. This is all I'm saying. Those components are back to their pre-pandemic contribution. So, okay, maybe that's a good thing. The contribution is there. The way that higher than expected CPI has been explained away is that, well, it's just shelter or it's just auto insurance. It's really not that big of a deal. That is true in the sense of it's just a couple components. It's not everything anymore. But the problem with that still remains prices haven't come down, right? They're still above on an absolute level. If you look at the CPI index, rather than looking at these percentages, the CPI index is at an all-time high. And the index of a lot of these prices remains at an all-time high. Not to mention, most people do have to buy car insurance.
Why is that not getting more of a focus, because I look at this data, and again, we often talk about expectations, market expectations, positioning into these sorts of things. And I look at this, Liz, and I say to myself, okay, well, I see a CPI year over year at 3.4%. That was what the survey was. That's what it was last, month, right? And I see, just the data at, the expectation, month over month was 0.4%. It came in at 0.3. Is that meaningful? You know what I mean? Because we're still at these levels of 3.4%. That is cumulative. If you look at all the data that's coming out about consumers, it's not particularly great here. So why is this the thing that causes, let's say, the 10-year yield to come in 7 to 8 basis points, to get this S&P 500 to break out to a new all-time high, up 1% or so? And then the other question is, isn't this all a bit muted too? Because maybe the data is muted. It's just like the pain trade is a bit higher right now. And that's a function of positioning.
Well, because it's all about the Fed at the end of the day. As much as I don't want it to be anymore, I'm tired of it being all about the Fed, but it is. And because they state their target as a year-over-year growth number of 2%, we focus on the year-over-year growth numbers that we're getting right now. And all of them are still above what their target is, but we're focusing on the fact that, well, it's moving back closer to what they want it to be. And then if you factor in, what are the things that are making it easier to absorb, or how have people actually absorbed it? It's that wage growth has gone up over the past few years as well. So we've been able to absorb that. The dollar has been stronger. So our dollar is worth more. You're getting more for it, which is great. So there has been some offsetting mechanism for it. But to your point about, I think now we're finally starting to hear from consumers in a decided way, I'm done paying these prices, or I have to change some of my habits because this is now unsustainable. And a lot of that, what was it called? Revenge spending and some of the revenge services and the revenge experiences that everybody was doing. I think people just said, okay, you know what? That's enough. I'm out of cash.
Well, it's interesting. So on the dollar front, that really matters more, far less for consumer, more for, corporates, right? When you think about that. But if I look at the Dixie, and maybe they can pull that up really quickly, the US dollar index, I mean, year over year, that's basically flat, right? You see that 200-day moving average. It's basically rising a little bit, but it's flattening out or so. And again, that's something that, it's that coupled with oil, coupled with yields, you know what I mean? Not a horrible sort of thing, I think, for corporate earnings right now. But again, let's go back to that 10-year yield for a second, because when I look at this and I see that 200-day moving average, you can see that uptrend that's been in place. It's the same chart as the dollar right there, right? Do you expect yields that have come from basically 4.75 down to 4.35 or so? Do you expect them to find some support? Because what I see right there, you could put a trend channel up, and let's do it, because Carter actually was on with us yesterday and he put out a note this morning on Worth Charting. So here we are, we've broken that uptrend that's been in place, right? You see his note from this morning. You guys can have that in your inbox. Just go to worthcharting.com. You also see that level that Carter had been talking about for a very long time, over multiple years. We're right back at that point. So we've had some fits and starts. We've had some overextension on the upside. We've had some overshoots to the downside, but here we are. We're basically at the average over those last few years.
Okay, so here's the thing about yields, and there's another chart that Mario and I brought today. I'm not quite ready for it yet, so don't bring it up yet, but I'm going to get to it when I cue you. Push the button. But here's the thing about yields. When the progression of data comes in at this point in a cycle, and I'm assuming at this point in the cycle where we are is late cycle, as the progression of data comes in, we shift our focus as investors. So we've been obsessed with inflation. We're still obsessed with inflation. But now that we're starting to hear, consumer sentiment is coming down, we're hearing that growth is slowing. We had a 1.6 GDP print in the first quarter, and the expectations for the rest of the year, except for the Atlanta Fed now forecast, but the expectations for the rest of the year are for below trend growth each quarter. The focus starts to shift to, is growth slowing too much? Okay. So when that happens, usually the reaction in the yield curve is this. The first phase is that the 10-year comes down faster than the 2-year, which is more of a flattening environment, right? Because people have growth concerns, so they buy longer term and they don't do it on the short end. That typically overshoots. So if it's overshooting to the downside, I do think it will find support at some point. I don't know where, I'm not going to guess the level, but it usually overshoots in growth concerns. Then what happens is, and things sell off, energy sells off, right? The cyclical sell off. Then what usually happens is the Fed reacts later to those growth concerns and starts to hint at or even confirm that they're going to cut. Then you see the short end of the curve plummet. and you have what's called a bull steepener.
Mhm.
So in this first phase, if we're starting the first phase right now, I think the 10-year probably overshoots a little bit to the downside, finds support, and then either evens out or maybe even rises back up again because of the overshoot. The next phase, if this is the beginning of our cooler inflation prints, the next phase is that we have a period of what would be a bull steepener, which is when short-term rates fall faster than long-term rates. And perhaps in that phase, the curve uninverts. So if you want to bring up the chart that I was talking about now, Mario and I sat back and said, well, what would happen if this was the start of cooler inflation prints and the start of perhaps a bull steepening environment? What do you want to be in? This is what you want to be in. Healthcare, consumer staples, utilities, energy, and real estate. Okay. A lot of that looking very defensive, except for something like energy or materials. Why? Because in an environment where the short-term yield is falling and the Fed is cutting, what's happening to the dollar? It's falling.
Yeah.
So demand for some of those things, you get benefits from that side of it. But this is just if we're setting up for a phase where inflation is cooler, the Fed's going to confirm cuts, we're pulling them more and more forward. I think the yield curve is going to steepen from here, and it's going to be a bull steepening environment. And it's not going to be bullish for cyclicals, right? It might be bullish for the market, but focus on some of the sectors that maybe you wouldn't expect to.
Yeah, and it's interesting to see, and maybe they can pull up the CME FedWatch tracker here. If you're just looking at, the June, July period, June is basically saying the Fed meeting, I think it's on the 12th, not a high probability that there's going to be a cut. But if you go out to July, it's basically saying maybe a 33% chance of a 25 basis point cut. If I go and look at September, which was to your point, things are getting a little bit meatier there. It's basically 50-50 or so. A lot of folks just think, at that point, why would the Fed dip their toe in the water at that point? We have a November 5th, obviously presidential election, and then things start to get really interesting with the probability in November 7th, that meeting of a 33% chance that yields on the 10-year are down, or Fed funds, are down 50 basis points. So again, might they hold off on September and go meteor? You know what I mean? But why would they do that? Is I guess the other, are things starting to weaken that much more? So we're going to have this kind of push and pull between this consumer data, between inflation data, right? And then GDP, which you just said came in worse than expected for Q1. And then as things are tracking for the balance of the year, it might come in kind of well below what the Fed's target was. And so in that environment, and Guy's been saying this for months, let's just say they want to kind of drop the mic on the rate hiking cycle and they want to do 25 or 50 at some point in November. Might that spark inflation? But the other thing is, might it start to investors or market participants start to anticipate that and start bidding up those sorts of things, which could cause further slowing in the economy? Does that make some sense?
So here's, if I were on the Fed, I'm not, they don't ask me, but nope. I like to think sometimes I'm pretty good at predicting what they might do. I don't think they're going in July. If things stay at this pace, they're not going in July, because if CPI even levels out or maybe gets incrementally cooler, that's just 1 quarter of cooling data after 4 straight months of hotter than expected data. That is not enough to give them confidence. The only way that July is even an option is if the labor market gets concerningly cooler. Yeah. Right. And I don't think we're anywhere near that either. It may get cooler, but I don't think it's going to get concerningly cooler by then. There would have to be something unexpected, some sort of unexpectedly bad data point or a couple of them to get them to go in July. So then September is really the earliest, in my opinion, that is on the table. Now, why would they hold off in September? They might hold off in September if there's not a lot more progress made on inflation. Or if we have an overheating again. One of the things that was interesting about Jerome Powell's speech on Tuesday was, as a surprise to no one, he said, we're keeping rates higher, right? But then the other part of it was they started to hint at, we're expecting growth to maybe be closer to trend. So rather than below trend, we're going to expect it to be in that 2-ish% range, which is right on trend. So if they're expecting growth to heat back up again, there is no urgency to cut because the economy is still okay. The November thing gets hairy because they don't want to look political. We all know that. I think the higher likelihood is that they do 25 basis points in September. And this is all things held constant. If the data stays the same on this trajectory, 25 basis points in September, skip November entirely, and then maybe do another 25 in December. Because that first cut has nothing to do with the actual cut, has nothing to do with the size. It's about the message.
Yeah.
It's that, okay, we have now started the cutting cycle. We are done with the pause. That's all that's going to matter.
Right. No, that makes some sense. Again, I think they probably avoid all of it until November 7th. And again, the question is, does that disappoint some market participants? Again, let's just pull up the S&P 500. We see a breakout here. It's up about 1%. It's trading very near 5,300. Your main man, and actually a very recent guest of On the Tape podcast, that would be Brian Belsky, who I've known for a long time. I think the world of. He's just a great guy, but a great market strategist also. He just went to street high here as far as his year-end S&P 500 target, 5,600. That's 300 points away. That's about 5.5%. Doesn't seem that sort of unlikely. I said this to you on Mondays on the Tape podcast, Liz. When you think about how far we've come in such a short period of time, we were just under 5,000. Now we're at 5,300. We're back again, like breaking out to new highs. What is the thing that establishes a new range above 5,300 and could kind of get you to a point where the S&P is up 15% or maybe 18% or even 20% or so? Corporate earnings, which are obviously very weighted towards those top 10 names, at least for the S&P 500, at some point, they're either going to actually decelerate, which I know that folks can't kind of get their arms around a little bit. And then you're going to have some of these other sectors that you just mentioned pick up some of the slack. That can really only happen if we have an economy that starts to inflect a little bit. Do you know what I'm saying? So to me, what's been driving the earnings growth in those top names is the excitement and all of the spending in and around generative AI, right? So if other parts of the globe are weak, to me, I just don't see some of those other groups, and we're going to spend some time in the banks a little bit, but I don't see those other groups picking up a lot of slack. So how does the S&P above 5,300 establish a new range? What are the conditions in your mind that makes that possible?
Yeah. And when you say the economy inflect, you mean inflect upward?
Yeah.
Okay.
Rather than, we could all say that, back in December and in January, the Fed raised their outlook for GDP growth for 2024 from 1.5% or so to just above 2%, which was basically, to your point that you made earlier, that was the pre-pandemic average or so, 2.2% GDP growth. Now it's coming in worse than that, right? And then we're also starting to see some issues that we've seen for a year or so in commercial real estate. We're starting to see, consumer credit go higher. We're starting to see delinquencies tick up a little bit, despite the fact that the theme, and you and I talked about this on Monday, resiliency of this consumer. But if it's on credit and that credit is resetting at higher rates, how much longer can that go for?
Yeah. Okay. So to answer the question about what are the conditions that would have to be present to get into a different range above 5,300. So I happened to be on a program called Closing Bell yesterday.
I saw it.
And I said,
Scott Wapner.
I think I got this point across, that if CPI came in cooler, we get to and through the all-time highs, right? But that we're gonna struggle around that level to find further durable upside because there isn't really any good fundamental news to take us there. So what would that news have to be? First of all, we have to get it, right? That we got CPI. There's not a whole lot more coming right now. And now we're in the normal pause between earnings season. I know we still have Nvidia coming, but the big stuff is over and it's not going to start again for a while. So there isn't anything coming down the pike that could drive us higher. So that means that the conditions would be market conditions. So yields have to be lower and falling. We have to allow for those long duration stocks to still look attractive. We have to allow for valuations to look attractive, which would require yields to be lower. So check that box. That's happening.
Can I just say one thing? And I don't mean to interrupt you. So long duration, that's a really good point. I mean, look at today. I'm looking at, Nvidia up 3%. You know what I mean? Again, in front of their earnings, which come a week from today. And, people are just getting right back into, think about this and pull up Nvidia's chart for a second here. This stock would have been consolidating between $400 and $500 for the better part of 6 months in the back half of 2023. And, when the Fed basically gave the all clear and signaled that there's going to be potentially six rate cuts in 2024, stocks like this absolutely took off. Now, obviously, there's a massive secular shift going on here, and these guys are a huge beneficiary of what's going on in generative AI. But just look and see, as soon as rates started coming in after the stock sold off in the last month and a half or so, now that we see that there's a path towards, more rate cuts possibly this year than thought 2 months ago, the stock's back on its horse.
Right. Well, and today is a day where you see 10-year yields down 10 basis points,
Yeah.
10 to 11 basis points, 2-year yields also down 10 to 11 basis points. So no surprise that something like this, a long duration growth play,
Yeah.
is on a rip. That is one of the big conditions that would need to stay intact in order for the market to find a new range and stay in that new range. Some of the other stuff, I mean, I think if you look at financial conditions, I tweeted this. I'm trying to find the exact day. It was yesterday, I think in the afternoon, if you guys can pull that up. So financial conditions, despite the fact that the Fed keeps saying higher for longer, we're not
They're getting
moving.
easier.
All of them, every index,
Yeah.
every financial conditions index is back down to where it was late 2021, early 2022. And 2022, as we know, is stocks sold off because financial conditions were tightening. So we are back down to loose conditions. Those have to stay in place as well in order for the market to really find more upside. But still, that's not a fundamental change in companies, right? That is a market condition that allows for momentum to continue. So I want people to keep that in mind. It does allow for momentum to continue, and that's okay. Ride the wave, ride the momentum wave, but keep in mind that there needs to, at some point, be fundamental support under that momentum, or things can come down just as quickly as they go up.
All right, let's get to the stock market here. Great tweet there. That's at Liz Young Strat. A little bit. Let's look at some of these sectors and let's think, going back to your bull steepener, going back to the potential for, let's say, some of these inflation readings to go for a series of kind of softer than expected. If you look at here, maybe they can zoom in for a second. That looks great in between us. But I can't
perfectly centered.
But I can't read it. Okay, here we are. So if you look at some of the performance year to date, you see the outliers. It's kind of interesting. Look at utilities. So you were just talking about some of these defensive communication services. Those are those long duration sort of names, right? So industrials acting pretty well. The XLI, a pretty decent chart. The XLK is a lot of those large mega caps also. So how do you want to be positioned? Like, let me ask you from a strategy standpoint, Liz, does it make a lot of sense at this point? You have a new high in the S&P 500. You see a bit of a broadening out. Yesterday on Market Call, we talked about over 75% S&P 500 companies above their 200-day moving average. Okay, so that's speaking to some pretty decent breadth. Do you chase it here? I mean, like I know a lot of folks are going to look at us and just say, okay, well, me in particular, maybe Guy too. You guys have been kind of like dour on the markets here. And a lot of it is we were expecting unemployment to tick up a little bit more, growth to come in below trend, the Fed to push out those rate cuts. And we just didn't think that was a great environment for investing in S&P 500 stocks when you have, above the 5 and 10-year averages trading above 20 times or something like that. But it's working. And that is, markets climb walls of worry. And that's what they're doing right now. We haven't even talked about geopolitics. Are there any sectors here that we see right there that you think could go outperform the S&P? Let's say Belsky's right. We get to 5,600 by the end of the year. Which of these sectors do you want to be involved in?
I would say I would stay away from the ones that start with the word consumer.
Yep.
Because we know that the consumer has started to at least hit the pause button. That's not a statement to say that the consumer is about to take us down, but I would stay away from those, especially, think about staples. Normally, if I were going to be defensive, I would say go buy staples, right? But staples have been one of the primary beneficiaries of price pass-throughs. And I think those days are done, where they might try to pass it through, or they might try to engage in whatever that was called shrinkage or whatever happened with the packaging. Shrinkflation, right? But consumers are over it. The jig is up. I think that's done. Consumer discretionary, obviously that's a mixed bag of a bunch of different companies. So driven by some of the stuff that, isn't necessarily related directly, but consumer discretionary also is going to see some pulling back. And I think that we're hearing that from retailers already. So I would stay away from those two. If we are in a bull steepening environment, there is a period of time when you come out of an inverted yield curve and you go into a bull steepening environment, financials actually do okay. They do better than they do in a normal bull steepening environment if it weren't inverted. But coming out of an inversion, if you have a really swift drop on the short end of the curve, I think financials have an opportunity to find a little more upside in that, especially absent some kind of big economic shock. Utilities, now, given what's driving the utilities trade, I do think some of it is AI, but I also think even if that is the case, this is something, just ride it. I mean, it doesn't make a ton of sense to me, but just ride it. And then if things get bad, Utes have that dividend side, that defensive side that should keep you going.
Well, hold on one second. So
normally,
look at that though, Liz. I
I
mean,
know
it just
it's a
broke
lot.
out. It just like,
Mhm,
again, it bounced off that 200. That was a month ago. You know what I mean?
mhm.
Like, look at that sort of performance. So again, I guess your point is, if you're long, stay long. You wouldn't be
Right.
adding here.
I
Yeah.
wouldn't enter here.
Yeah. I just want to
Absolutely.
be really
Yes.
careful
And
there.
to be fair, I am long utilities. I
Okay.
bought utilities in a couple different lots over the last 6
You
months or
mentioned
so.
it on many occasions on Market Call that you did do
So I'm
that.
long. I actually considered trimming because I thought, am I too overexposed to this big run up that they've had? I'm not going to add to them, but I did not trim either. I'm just going to hold steady
Should
for a little while.
small caps finally break out in this environment that you detail here? Because again, we've talked about their, dependent on credit and the
Mhm,
like here, and access to
mhm.
capital and cost of capital, and then obviously, some of this, underlying consumer weakness,
Mhm.
will be felt in these companies for the reasons we just mentioned, probably
Yeah.
more so than large cap peers. Again, we've talked about this. If they want to pull it out to a 5-year, also, I mean, this has just been so range bound. It has not provided a whole heck of a lot of alpha. You know what I mean? And that's something that I think people usually think about when you're going to have, a market that might be inflecting. You play
Mhm.
a little catch up here. It doesn't just seem to be the thing to do. I mean, over the last year and a half, Liz.
Yeah, I mean, honestly, it's a little bit of a head scratcher that they
Yeah.
haven't broken out more,
Yeah.
right? They've made so many attempts, and given the drop in yields that's occurred, and even today they're up 1%. I mean, it's not that much of a breakout
Right.
that I would say, okay, this is the time. I still think that at some point there is a pullback coming. Even this year, I think there will be. And it's not necessarily something that is going to be recessionary, but just a tree shaking, right?
Yeah.
Some of this stuff, the run up has been, again, not entirely fundamentally supported by the economy. I do think that stocks will give some of it back, and small caps are likely to participate in a drawdown. But I would have thought that they would have done better
Yeah.
given the rest of the environment that's going on, which is why people look at these and say, well, something's still not right, right? Something still doesn't feel right about this being like all systems go on the bullish side.
Yeah, and I just say this, so Nvidia next week, we have Walmart this week. We talked about some of the other names here. We might get a little better sense of how Q2 is shaping out by some of the commentary that these companies give us as you think about, they're kind of squarely in the middle part of Q2 here. And then quickly, as we get into, the end of the quarter, we're going to get focused on Q2 earnings, right? And then really what the back half looks like. And so the whole idea that we're like rallying the way we are to new all-time highs today on a softer than expected inflation print, I think it's interesting to hear what companies are saying. Okay. So this is the point of the show where we're going to focus on our main man, John Butters. He's the senior earnings insight analyst over there at FactSet. Look at that. You can have the earnings insight in your email box. Go to insight.factset.com/subscribe. It comes out every Friday morning. John sends us a preview of this, and I just want to kind of hit this one before we get into Cisco earnings tonight, Walmart tomorrow, Deere, because this register of companies that are talking about inflation, I think is really interesting. It's interesting to track. It's something that I'm going to be very focused on as we get into Q2 earnings in July. But John talks about the term inflation having been cited on the Q1 2024 earnings calls of 217 S&P 500 companies. This marks the lowest number since Q2 2021. That's interesting to me, especially after those consecutive prints that we've had and the 7th straight quarter-over-quarter decrease, but still above the 10-year average of 180 at the sector level. And you just mentioned this sector, consumer staples, 86%, and financial, 72% of sectors have been the highest percentage of companies citing inflation on Q1 2024 calls. So away from staples and away from financials, they're well below the average over the last few years of citing inflation. So why is it that corporates are not talking? It seems like an easy one to talk about when you still have cumulative, year over year increases of 3.4%.
Yeah, well, I think it is still easy for staples to talk about. I mean, both those two have been some of the hardest hit directly by inflation. So that makes sense to me. The rest of it, I mean, I think we shifted our focus. It started to be, instead of let's mention inflation as an explanation about why our results might be challenged, let's start talking about AI as an explanation for why we're going to be so good, right? And that happened for the last few quarters. That's been really the focus. And I think just as sentiment shifts in the narrative, it's like a tired excuse, right? And because, again, I think price pass-throughs are running their course. I think that has become an old thing. It's long in the tooth. Companies can't justify it anymore. So if you're trying to justify price pass-throughs by talking about inflation, and it's not working, right? You're losing market share. Demand is falling because of it. You stop doing that. So, I mean, there's probably other things happening too. You've got prices coming down for inputs, and they're not dealing with as much, increase in gas prices and all the other things that go into it. But it's kind of fascinating, actually. I mean, and I remember talking about this back in 2021 with you guys, and in 2022 too, where it's like, yeah, of course they're talking about it a lot because they have to justify what they're doing in their results.
Yep, no doubt about it. All right, thanks to John Butters, and you guys know where you can find Earnings Insight blog right there, and you can have it in your inbox on Fridays. Let's talk a little bit about earnings. You know, Cisco tonight after the bell, they're not likely to be talking much about inflation. Okay, to the point, it's just not something you think about. Their exposure, it's government, it's enterprise, the geographic elements of it. It is what it is. To me, with a company like this, given their end markets and the like, it'll be interesting to see. Then, they just digested this Splunk acquisition, and let's see what they're talking about as it relates to generative AI. This is a company that likely is to, have some services attached to some of their software and recurring revenue models that they've gone really heavy into over the last few years, because they recognize the fact that the hardware business is hard, as we keep going on and on here. So this one will be interesting. Implied move about 4%. You can see a couple of those gaps over the last year. The company has disappointed on a few occasions. It's not a particularly expensive stock. There's some things that they could probably say as it relates to the ecosystem and in the secular shift with generative AI and data center and security and all that sort of stuff. But again, this stock trades at about 13.5 times earnings that are not expected to grow this year, and probably low single digits next year. So not particularly interesting to me, but I always find companies like this, with the geographic exposure they have and the mix between enterprise and government, pretty interesting. Liz, the government has been responsible for a lot of the hiring. The government and there's going to be upgrades across the board as people think about Gen AI. Any data points on enterprise spending? Anything interesting to you? I know that there's outliers like Dell, there's outliers like Nvidia, that sort of thing. But overall, enterprise software has been really weak this year. And I know that you used to kind of throw up a bunch of charts of semis versus software and the like. And it just seems like that the semis are also bifurcated between those like Nvidia that have generative AI chips, and those that maybe AMD doesn't have a great chip, or the guidance that they gave not particularly great. Intel has not been executing. They've been getting their lunch eaten in data center and the like. But then on the software front, there's some of these large names like a Microsoft is obviously right there in the game. But then Adobe on the other side is down 20%, and from its recent 52-week highs. So there's a lot of dispersion going on in the software space right now.
Yeah, there is. So typically what I look at is semis versus software for a cyclicality signal. It's a lot like looking at staples versus discretionary. When cyclicality is winning, you see semis outperform software. So that's what's happened this year. Cyclicality, though, on a thematic front is what's been winning. Software is, first of all, a slower decision to make for companies. They don't just flip a switch and switch software providers. It's stickier revenue, so you don't expect as much volatility in software stocks. And if you want to get defensive in tech, a lot of times people might say buy software instead of semis. So that's part of, I think, what's going on, is that there's just been more risk appetite, so semis have done well. Software spend, I think right now, I don't think there's a ton of changes going on at companies. I don't think they're making a lot of changes because they're trying to spend on semis instead, right? And they have to make a choice. There's
you mean
only
when
so
you're
much...
buying a $40,000 GPU from Nvidia, and they have all the pricing power, and you're not just buying one or two, you're buying hundreds, if not thousands of those things. I mean,
and trying to keep up. It's table stakes for a lot of these companies now. You're trying to keep up with that trend. And at that point, it's like, okay, so our human resources software that we've been using for 5 years is fine. We don't need to do anything with that. And a lot of it might be that software is used to help companies preserve costs, right? Help them be more efficient, and maybe they're focused more on growth than efficiency. I mean, I'm completely pontificating here, but it just hasn't been the
focus.
It,
by the way,
it hasn't been the focus, and it hasn't been the focus because it's not what's been rewarded in the market. And I think that's probably the key.
Yeah. And, I'll just maybe they can pull up Adobe for a second here. So again, last summer, they had this generative AI Firefly announcement and how they were going to be deploying that technology across their suite of services and the like. And it seemed like a really easy name to kind of get swept up in as far as beneficiaries of generative AI and the spend that they've had on machine learning and the like here and some of the acquisitions they made. It's a company right now that's got a $215 billion enterprise value, good balance sheet, $7 billion in cash, $4 billion in debt, 89% gross margin company that's expected to grow earnings and sales 11% this year, 11% next, trading about 27 times this year and about 24 times next. This seems like a reasonable name. Now, you could say, well, why is the stock underperforming so many of its mega cap software peers? The whole space, and let's pull up the IGV for a second, just seems to be, if you're not Microsoft right now, you know what I mean? If you're part of that kind of former SaaS sort of contingency that was doing so well post-COVID and, this Snowflake and this and that, they went on and on and on. I mean, there might be opportunities here. I mean, to me, this looks pretty constructive, especially if Belsky's right. We're going to 5,600. You're going to see tech also starting to broaden out a little bit. And again, there's nothing fundamentally wrong, in my opinion, about an Adobe. But if I look at the IGV and I say, all right, this is how I might play some catch up in the market and keep a tight stop on that. Does that make some sense?
I think that makes perfect sense. Yeah. Well, and the other thing is, I think even, and I don't want to talk about meme stocks for very long, but I think some of what happened in meme stocks is that because we've had such a strong rally, I think everybody can look at the market and say, okay, momentum is intact, but my God, everything has run up. What do I even buy now? Where is there more upside? What's even fallen behind? And it's hard to find some of that in the semiconductor space. It's hard to find that in all these names that have done so well. So you do have to start digging. And if the market is going where Belsky thinks to 5,600, these names absolutely will participate. And if it gets to 5,600, I can only assume that that has to be in an environment where yields are still falling, or at least are staying where they are. In which case, that's more of a tailwind. I want to clarify one thing from Belsky because I talked to him just before this. The year-end price target is 5,600, but it does bake in that there is a larger correction between now and then.
What?
So he does think that there is a pullback that happens. It just starts from a higher level.
We're going to have to get him back on the pod because let's just say we were just at 4,950. We're at 5,300 right now. If we get a larger pullback than what we had, which is about 6% in the S&P from that recent high back to those lows, and now we're back making new highs. I mean, think about this. Let's just say we went to 4,800. Okay, that's a 10% peak to trough decline from where we are. The average, this is what makes me nervous here a little bit, Liz, is that, strategists on average are 5,140. Is the chase on right now? Do you know what I'm saying?
Of course it's on.
I know, but Belsky has been very bullish, so we give him a lot of credit for that. He's been on the right trade. And listen, if you're a strategist and you put year end or 1 year price targets and you do really good bottoms up sort of work and you kind of work from the macro top down and you arrive at your S&P 500 earnings levels, you're using all these macro inputs. The idea that a 5% sell off from an all-time high in the S&P 500 should shake you, that's pathetic. It should not, right? And we talk about this all the time that, I think the average peak to trough decline in any year over the last 50 in the S&P is about 10%. You know what I mean?
It's actually 14%.
Is it really?
14%.
Okay.
Yeah.
So we didn't have a 14% decline last year. We haven't had one so far this year. You know what I mean? So might that come? Maybe. But again, the market just seems to be not particularly worried about most of the headwinds that, let's say folks like me are focused on. It is interesting that JP Morgan lonely all the way down there. You know what I mean? And listen, a lot of folks on the internet, they get their beer muscles on or whatever, and they like to make fun of those guys. Those guys down there are doing just as good work as the folks that are up there at 5,600. We can't always get things wrong. And I'll just say this is that, what part of our existence and what we're doing with Market Call or On the Tape or OK Computer is kind of figuring out the sorts of things that can go wrong. I mean, it's great that you have a bunch of people with pom-poms all the time, just kind of rooting the market higher or whatever. I like to know how things can go wrong too, either side of any trade. So that's kind of my view. Do you think there's going to be a catch-up trade, Liz, a throwing in of the towel of those folks who have a price target? Well, it doesn't matter. I'm not saying it just speaks to sentiment, in my opinion, when you do have those folks that you have the bears finally throw in the towel.
Well, I mean, that's really what the definition of capitulation ends up being, right? You've got the last holdouts that throw it in and just say, you know what, I have to admit that I'm wrong.
Yeah.
And even if I still think that it's going to happen, the reality is it hasn't, and it doesn't appear to be anywhere on the near-term horizon. So in the meantime, I'm losing money if I stay this bearish.
Yeah.
And I mean, that's a conversation I've had to have with myself. And I have gotten more bullish this year because not that it makes sense, right? It's momentum-y, but the reality that I've come to is that there's still a lot of buying appetite. People have risk appetite. And it's going to take a lot more than 1 or 2 hot CPI prints to send this market off of its axis. So momentum is here. I still think that we're going to find trouble getting comfortably above 5,300 and staying there without more fundamental support. That doesn't mean that it's not going to happen. We're going to shoot up, but that's momentum-y, right? That's a short-term overshoot that I think will give some back. And even though BMO up there at 5,600 looks a little ridiculous from here, I don't know when that pullback might end up happening that Belsky thinks is coming, but coming from a higher level and a bigger drawdown than he originally thought, which I think was about 5%, 5 to 8%. So maybe a bigger pullback than that then results afterwards in a market that goes up to 5,600 by the end of the year.
And again, I guess, the complacency that we're seeing, the market was positioned for this. We're getting the move on the weaker than expected CPI. I guess, we could get right back into earnings, and Walmart, is going to be, tomorrow morning before the opening, and let's see what they have to say on the consumer. Like we heard what Disney had to say, we heard what Starbucks had to say, we heard what McDonald's had to say, we heard what Home Depot had to say. I mean, there is a little bit of a pastiche, forming as it relates to the consumer. So to me, I think, back to November and the quarter that they reported, they were talking about a consumer that was weakening. They were talking about the benefit of the trade down. Let's see, how that shakes out tomorrow morning. I'm positioned for a move back towards that 200-day moving average over the next month or so. I just don't think that the benefit that they've been getting from inflation on the food front and some of the trade down aspects is going to continue. So let's see. Earnings might take over, guidance might take over, visibility might take over, which leads me, Liz, to a question. And if you have questions, guys, put them in there. Amanda's going to give them to us. We have a few so far here. This is from Sebastian Lassis. Is there any reason to own stocks now until the election, perhaps earnings? Now, the question, it's not too different than some of the things that we've been talking about, but the time frame of election. Have you and Mario done any work on how stock markets act into presidential elections, which obviously happen every 4 years here? I think generally you see some sort of trepidation at some point, but then you see a rally into them a little bit. Is that right or no?
You typically see a rally afterwards and a relief that the uncertainty is over.
Okay.
Also, so we've done work too on, does it matter if there's a Democrat or a Republican? Does it matter if the House is Republican or if it's all the different things, right? And it turns out the best performance happens when we have a split Congress. Period. End of statement. Doesn't matter if there's a Democrat or a Republican in the White House. Those two, with split Congress and Republican in, split Congress and Democrat in, those are the highest performances for the S&P generally. The way that the market typically acts in an election year, so far this year, we have not followed that all that well. Typically, you see it have a little rally early in the year and then a pullback into March, and then it springs back up again. The timing of that hasn't followed this year yet, but later in the year, you do usually see volatility just before the election. So starting in September and October, you see volatility. So we might see a pull down at that point. But then the relief of it just being over and knowing what's happening. And if we end up with a split Congress, then I would expect a rally afterwards.
Well, it's interesting. And what's different maybe this year, and I'm sure this is going to frustrate lots of market participants, lots of strategists, a lot of politicos and the like, is that we know these two folks that are running against each other very, very well here. And so that might be the thing that's different. And, the other thing is like their positions on a lot of stuff in the economy are not that far apart. The margins in the House and the Senate are not that great. I think it's a couple or a few in the House and one in the, in the Senate. So the likelihood of having a split is pretty good. So there's just a lot of uncertainty that's taken out of it. Now, to me, that's kind of all bullish for the market. The former president used to tweet out every day at 4:01, you're welcome for new highs in the S&P 500. No, I mean, he did. And it seems like this administration doesn't care about that, which is kind of good in a way. I mean, I think about our commentary from 2016 up until, early 2021. It seems like we were talking about what's going on in Washington every single day as an important input. And it's been nice over the last 3.5 years that we haven't had to do that. We could just focus on companies. We could focus on themes. We could focus on the macro. Even, the last couple of years has kind of been dominated by geopolitics to some degree, but less so about, things that the administration are doing and saying. So to me, that's how I was brought up in the market. There wasn't a lot of focus on what DC was doing. I wish we could get back to that.
Well, I mean, I wonder if this ends up being that way, though, right? Not to say that the election will be a complete nothing burger.
Yeah.
But what if there's not much of a reaction at all?
Yeah.
I mean, the last time that Trump went into office, there was a big difference between what the Democratic policies would have been on trade versus what Trump's policies would have been
similar
on
right
trade.
now, to your point.
And right, so that gap has closed.
Yep.
There's just I don't know that a lot would change policy wise that's going to move the market that much. I mean, taxes, right? The big things that moved the market last time were trade and taxes.
Yep.
Right.
Well, taxes are going to become a big thing because those tax cuts expire next year. Okay. So if Biden's in office, those are not going to be re-upped. Okay. And so where did those go? They borrowed $1.5 trillion from the future, and they basically just gave them to U.S. corporations and wealthy, folks. Right. And what did the corporations do? Literally in the 2 years after 17, when those tax cuts went into place, $1.5 trillion of buybacks was completed.
Yeah, it was buybacks and dividends.
Yes, right. So, which is absolutely amazing. And again, so that's one big difference. That's not going to happen. But the idea of the trade stuff with China is here to stay, no matter who's in the office. So again, own until the election. I mean, if you're bullish on U.S. corporate earnings and you think the geopolitics and the situation around the world is going to cool out a little bit between now and then, which it probably does in an election year, right? Like there's no reason to kind of test the waters if you're China on Taiwan right now. Obviously Russia would much prefer to have their main man, Trump in office. I think that they think that would kind of tip the scales as it relates to what's going on with Ukraine. So again, I'm not sure how that sort of plays out, but it seems like, listen, if you're bullish, like keep raising your stop. How's that? All right, Liz, here's one. Guy's not here, but we have two questions. One from Jim Foster. What are expectations for gold and the gold miners? And then Edward Morgan asks, copper, silver, and gold. Comment, please. Do you want to start with gold a little bit? This is one where, I know that your people over there at the SoFi are probably more focused on the nerd gold. That would be the crypto, which is actually having a huge day today. Maybe they could pull up the Bitcoin chart up 5% or so. I'll just give my 2 cents really quickly on gold. I mean, Guy, Danny, they've been all over this. I know you've been talking about you should have a low single digits, exposure to this or whatever. The thing is up as inflation expectations have been coming down, a little bit. And so to me, I don't really get gold. I get it. If you have a diversified portfolio, the idea of having some, you're going to move like this. Great. You're pretty happy about it. The stock market's working pretty well too. You know what I mean? Like it's all good. I don't see the dollar coming in that dramatically right now, just given some of the other forces at play and other demographic situations and the like. So talk to me what you're thinking about gold after this huge ramp over the last few months.
Well, I do own gold in a number of different ways. I own the PHYS and I own GLD. To be fair, I trimmed GLD just the other day because there's been such a big run up and because my thesis for being in gold had a lot to do with what was happening in the yen and what was happening in global currency markets. And it's not over. I don't think it's over, but it has calmed down a bit. And given this big run, part of that, the driver of this run, I think, has been central banks purchasing gold, trying to get away from currency volatility, trying to get away from getting hurt from dollar strength. Now that we know rates are higher for longer, to your point, the dollar is probably going to stay strongish for a while, maybe not get that much stronger, but it's not likely to weaken anytime soon, or at least weaken considerably. So it could be that parts of, gold has seen a decent run up. Maybe it stops here. I don't think it's going to plummet down, especially if rates continue falling. I think it does stay elevated. But if it's something that you already own, I would say you can keep holding it. I was pretty overexposed to gold, frankly, and it did well for me, but it was time to trim some of that back so that I had money to put in to other things that might participate in a next leg of the market up if that happens.
All right. So again, as we talk about the next leg of a market up, we kind of highlighted the IGV. Again, if you thought that, the S&P was going to establish a new range above 5,300, the NASDAQ was going to play catch up and get back to a new all-time high. That makes some sense to me. As it relates to the S&P, let's pull up the BKX here. So we kind of alluded to banks in the scenario in which you talked about a bear steepening. Look at the BKX. Okay, so this thing is obviously broken out. It's making new 52-week highs. Maybe they can put a 5-year on this thing a little bit. And I find this interesting because if part of the trepidation on the large money center banks was yields going higher for longer, held to maturity, mark to market, marks that they're taking on their treasury portfolios, that would be Bank of America and Citi and the like here. Well, here we are, and I highlighted this yesterday. Look at if you just drew a horizontal line from that first gap in February of 2023 as we kind of worked into the regional banking crisis, we're basically back above there. We're still well below the all-time highs made, in late 2020. But I look at this and I say this could be a little bit off to the races, especially, and now if they could pull up JP Morgan, on a 1-year basis. This is pretty fascinating, Liz. Stock was making new all-time highs seemingly every day for you just look at that for a few months, consolidated into its earnings print, had a 6.5% gap, was probably down from its highs about 10% from those highs, and now here we are, filled in the gap, but that wasn't enough for making new all-time highs. Whatever investors were worried about on April 12th, as Jamie Dimon was talking, as he was
saying things are going to be bad.
Yeah, no, they're not worried about now. So they're basically, again, best banker in the world, best bank in the world, whatever you want to call it, right? Like, he's been fairly cautious every time he kind of opens his mouth a little bit.
Yeah.
So talk to me about banks, and then I want to talk about regionals a little bit because they're still lagging.
Yes. Okay. So banks in a bull steepening environment, first of all, if short-term costs come down for banks, and always remember, banks lend long, borrow short. So if short-term rates come down, their costs go down. If long-term rates stay elevated, their revenue from lending stays elevated. So that would be just straightforward good for banks. So I think if we do enter that environment, I actually do think banks can find a little bit of upside there. The big banks have benefited, in my opinion, from the fact that the economy has stayed strong, capital markets activity has heated back up, rates are down again, so you're seeing that activity heat back up. We're not sort of frozen at a high rate, high capital cost environment. That, I'm guessing, is part of what JP Morgan is benefiting from. The other thing, and this might be a little bit of an intangible piece of it, but because Jamie Dimon has been so cautious, I think you can look at JP Morgan, and I'm not saying buy or sell JP Morgan in any way, shape, or form, but I think you can look at it and say, if you're an investor who's worried about companies not being cost conscious or not being cautious enough, being too complacent, for example, in this environment, they're probably not one of them, because listen to what he's saying, right?
Yeah.
He is anything but complacent, still worried about recession, still worried about higher rates on the 10-year. So I think people are trusting perhaps that he's managing it in an environment where very aware of the risks and not overexposing the company to something that they'll get blindsided by.
Yeah, and Doug Cash just hits me from Seabreeze, and he writes over there at Real Money, a friend of the pod. He's been writing this. He's been cautious of late on the banks. Doug has forgotten more about investing or trading bank stocks than I will ever know. He talks about the underperformance of some of them late, and it is important to note. JP Morgan is down a little less than 1% on a day where everything seems to be screaming. But when I look at my screens, Liz, there is some stuff that's down. And so like a Nike is down today, and we have some consumer concerns as we kind of discussed. Look at Walmart, reports tomorrow before the opening. We previewed it yesterday a little bit. Are there things, and I just want to kind of come back to this because again, the consumer is the linchpin to me, right? And if the consumer is 2/3 of US GDP and GDP is coming in less than expected, you better watch what some of these massive companies that have hundreds of billions of dollars of revenue here are saying about consumer trends. Do you think that Walmart and their guidance has the potential to kind of unseat this kind of market rally a little bit? Last night on Fast Money, Katie Stockton, who is a technical analyst, she was saying that yes, I could see on a benign number the S&P gapping up, making a new high, but then failing. Okay, so if the market action today with yields down, dollar down, oil down, inflation down causes a move higher, and it can't follow through to tomorrow. And then market participants seem to kind of focus on, let's say, earnings and what these companies have to say about their consumers. Is that the thing that could cause this kind of weird period with no news? And let me tell you something. The likelihood next week that Nvidia has a huge gap on a massive beat and raise, to me, is not that likely, especially of what we've seen from some of their customers and some of their competitors. But again, I've been wrong on this name for a very long time. So, well,
maybe it's time.
No, I mean, listen, to be fair, on January 5th, I went on CNBC's Fast Money. I'd said it on Market Call. I said, you played this thing for breakout when the stock was $490 and it immediately went up $200. So again, I don't get any credit for that. I'm not here to whine about that. I've been talking about the fundamentals of this company and how I think I know this will probably end. You can have a ball and you can buy something up 100% on the year into a print if you want after it's gained $1 trillion in market cap. I just don't think that's particularly sensible, just to be very honest.
Sure.
You know what I mean? I'd rather play it through the SMH or some of the QQQ, is something I've said consistently. I don't love the idiosyncratic risk of something like that. But when I'm at a Ranger game on Monday night and I see a friend of mine's kid who's home from college who's telling me he's getting shit rich long Nvidia, and I was out in LA last week and another one of my buddies' kids who's 13 years old is showing me his Greenlight account, showing me how much money he's made in Nvidia. I know the jig is up soon, people. I'm just telling you that right now. So I'm not your guy who's going to get you in and out of any good trades in Nvidia other than that one on January 5th. But you understand what I'm saying here, Liz, a little bit?
Yeah, well, they're called unrealized gains for a reason. You're not really rich until you sell it. So it can go away very quickly.
Just, you know, I was having the same conversations with people a year and a half ago in Tesla. Okay. I mean that, like with kids and stuff like that. And now all of them, none of them talk about how they got their, asses beat in Tesla. I'm just saying.
I mean, if you get out at the right time, people will make a lot of money.
They never do.
Right. I get it. I get it.
Because they're manias.
So look, I mean, some of these stocks, this question began with Walmart. Will Walmart's results, do they have the power to bring the market down based on what they say? So first of all, if we're talking about a consumer that's trading down, I would expect something like Walmart to benefit from that. However, we heard McDonald's talk about a consumer trading down. I would have expected McDonald's to benefit from that too. So I don't know what we're going to hear from Walmart. I think the only way that it really is a concerning thing for the market is if something comes out from their guidance that says consumers are changing their spending habits in a drastic fashion, right? They have stopped buying X type of goods and they're only buying toilet paper. I don't know. You know what I mean? Like that sort of pandemic style, we're only buying the absolute essentials. Or if they say nobody's buying clothing anymore, they're only buying toothpaste. Then, okay, maybe. I would be surprised if that's the case. Now, we might hear something from them, which I think would be on trend. We might hear something from Walmart or other retailers that sell this kind of stuff. Maybe consumers have stopped doing big ticket purchases. Maybe they're spending less on televisions and more on essentials. But that would make sense. And that is sort of a trade down, right? You're not spending as much on big stuff. So I don't think it's going to take the market down, but I think it's absolutely worth listening to.
Yeah, no, again, I mean, I think that, again, it would be part of a broader narrative that is coming out of, Q1 earnings period. And as we are midway through Q2, I mean, that would be the sort of thing that you start thinking about. All right, what are we likely to hear as we get into July? Are we starting to hear possibly of some pre-announcements? That's not something we've seen a whole heck of a lot of over the last, kind of year or so. I think that was more of a 2022 thing. But again, I think, the good news is for those who like to pick stocks and like to look at companies and their products and their services and what their management have to say, I think that we're probably going to get into a period where that's more important than the macro, because I don't think there's a strong likelihood that we're going to have rate cuts between now and November. But to your point, and you made it about a half an hour ago, the signaling of that will probably be the most important thing. It's the messaging and the like here. All right, Liz, you and I covered a lot of ground. We missed Guy Adami.
We did.
Guy's going to be back tomorrow. Carter Braxton Worth will be with us tomorrow. Liz will be back with us on Monday morning for the On the Tape podcast. We have a really fun episode that we're recording tomorrow with Steve Eisman of Big Short fame.
So he's never been on before?
Never been on the pod.
What'd you give him to get him to agree?
No, he wants to come on. We've gotten to know Steve. You've gotten to know Steve a little bit, haven't you, with us? He's been down at the iConnections with us. He did a great on stage thing. Melissa Lee had Steve Porter, Vinny, and Danny Moses on stage at iConnection. It was awesome. The first time they had been together really since like the movie and the book and some of the stuff they did around that, which is I think 10 years ago or something like that. So we're really looking forward to that conversation to see what Steve has to say on markets. Guy is going to be back. We're also sitting down in just like an hour. I'm going to be speaking to Jan van Eck. He is the CEO of Van Eck. It's an ETF company, and you know some of those ETFs. We talk about them every day. It's the SMH, it's the GDX, and it's also the BBH, which is biotech, another one. There's a few others there that we talk about a lot. So sector ETFs, really excited to hear what he's got to say about the ETF industry, which sometimes is controversial. I don't get it. I use them. I've been using them forever, and I think they're just a really useful, low-cost, liquid way to express views of the market. I also trade options on them. So to me, excited to hear what Jan has to say about that.
Me too. Why are they controversial?
You know, a lot of folks just don't like them. I mean, like without naming any names, there's some people on CNBC who think they're like, you know, like really bad. I mean, to me, I think they're great for hedging purposes. I think they're great to express views and like sort of secular shifts and not have so much idiosyncratic exposure. You know, in the SMH, for instance, as you know, as Nvidia has become this monster, you know, it went from being single-digit percentage to, and I'll just pull it up right here. I think it's, you know, as high as 27%. And so to me, you get exposure there without actually being all in. You know what I mean? Now, you know, let's just say Nvidia is down 10% and it's, you know, 20% actually right now, the SMH, you know, there's going to be a lot of those peers down in sympathy with it. You know what I mean? But you don't have the potential where you have one stock down 25% and that's just like blowing a hole in your portfolio. You know what I mean? So
okay.
Diversification. All right, Liz Young, thanks for being here. I know you got to get out of here. We went long. I really appreciate it. Thanks to SoFi, one of our fine sponsors, obviously FactSet, for all the data that we show you here. Thanks to our team, and we'll see you tomorrow.